I've been asked many times, should I trade trend following or mean reversion strategies? If you are starting out in trading and struggling with this question, I've made this video to help you out. I'll start by explaining the concepts behind trend following and mean reversion using an actual backtested strategy as an example. I will contrast the pros and cons of each strategy, and finally, provide my recommendation for retail traders.
The goal of trend following is to exploit a market's directional momentum. You simply jump on board the trend and exit when it ends or reverses. In many cases, trends are triggered by major changes in central bank policies or economic outlook, subsequently fueled by herd mentality and traders rapidly closing losing positions. Regardless, there is no need to figure out why a market is trending or when it's going to trend. You just jump on board any trend that arises, just like how you don't need to understand electricity to use it. This trend strategy here uses the Darwinex channels, formed by plotting the highest high and lowest low over the past 80 periods. I go long when prices close above the upper band, accompanied by high volatility and a rising EMA. A 100 pip trailing stop lets me ride the trend until it reverses. Here's how a successful trade plays out. For the complete strategy logic and how to program it for free, check out the link at the end of the video. Mean reversion strategies operate on the assumption that prices fluctuate randomly around their historical average. This average is defined by the trader. If you're using the Darwinex channel, it would be the middle line. Another common example is a moving average. With the millions of market participants transacting trillions of dollars for various agendas, these random fluctuations, also called noise, are a permanent feature of any market. In the absence of any fundamental impetus, any extreme price deviations are expected to rebound quickly towards the mean. This means buying an oversold market and shorting an overbought market. This mean reversion strategy applies the pivot points to the 5-minute euro franc. Long signals are generated when prices cross above the pivot S1 midpoint, after which a limit order is placed 3 pips below the midpoint. This not only gives you a better entry price, but the more oversold the market, the more likely it is to rebound to the mean. Exits consist of a tight 20 pip profit target and 60 pip stop loss, together with an end-of-day exit 5 minutes before the New York close. Now let's contrast the pros and cons of each strategy type. Trend following strategies have a much lower win rate. Here's a comparison of the backtest statistics for the two strategies mentioned earlier. You can expect trend strategies to have win rates in the 30 to 50% range, and mean reversion strategies to have win rates above 60%. The reason for this discrepancy is simple: markets don't trend often. Major events or news releases don't happen every day. Many breakouts will quickly revert to the mean. If you want to quantify how much your market trends, check out my ADX trend counter algorithm at the top right. So if you find a high win rate psychologically appealing, mean reversion would suit you better. With trend following, expect to endure long losing streaks. But this isn't the full picture, which brings me to the next point: trend strategies have much larger wins than losses. With a correctly executed trend strategy, you either set a wide profit target or ride the trend until it reverses. When your market eventually trends, one large win will make up for a long string of small losses. This is demonstrated by your payoff ratio, which is usually more than 1.5 for trend strategies. A consequence of this is that you need to take every entry signal, because you can't afford to miss the outlier trade that holds up your bottom line. Mean reversion strategies are the opposite. When you have a loss, it tends to wipe out a number of previous wins. If you only trade mean reversion strategies, your overall portfolio hit can be severe in times of market panic, when markets start trending unexpectedly and there is a mass exodus towards safe haven assets. Third is the difference in holding periods, which depends on your choice of trading timeframe and exits. In general, trend-following strategies perform better on the higher timeframes, which smooth out much of the noise, making price action much smoother. This means fewer but more reliable entries, and less likelihood of being shaken out by temporary counter-trend momentum. The flip side of higher timeframe trading is the longer time in the market and the increased exposure to unforeseen price shocks. Examples would be weekend gaps caused by geopolitical conflicts, or even insane central bank interventions like the euro-franc crash of 2015. On the other hand, for mean reversion, you want to take advantage of noise, and the lower timeframes are where you want to be. Next is a crucial difference: your entry and exit precision. Most trend followers trade relatively infrequently on the higher time frames, attempting to ride large trends. This means your average profit per trade, or expectancy, is higher. If I have a poor entry and exit, say I lose 2 pips each on the entry and exit, the trend strategy will still be profitable, but the mean reversion is now untradeable. As demonstrated earlier with the Donchian breakout strategy, even basic rules can generate profits. Take it from renowned trader and author Andreas Klenow, who said in his book, "The secret sauce is not in the buy and sell rules." This expectancy buffer makes trend-following strategies much easier to develop. Another downside of having a small expectancy is your strategy's sensitivity to transaction costs. If you underestimate your transaction costs during backtesting, or your costs unexpectedly increase during live trading, there may be little profits left on the table. Check out this spike in spread for the pound Canadian shortly after the New York close. If your mean reversion strategy transacts during these hours, you're probably flying too close to the sun. Be sure to include realistic transaction costs in the form of spread, slippage, and commissions when backtesting your strategy. Here's a summary of the differences between trend following and mean reversion strategies. Before you pull your hair out, why not consider trading both trend following and mean reversion strategies? Such strategies are rarely correlated, which means you can easily combine them to create a diversified portfolio. You get higher risk-adjusted returns and shorter equity stagnations. If you automate your trading, you can easily trade multiple strategies 24 hours a day. Check out the video at the top to learn to program your own trading strategy for free. But what if you had to pick one? There is no right or wrong choice, it just depends on your preferences. If you're a time-crunched, part-time retail trader, I suggest trend following for the following reasons. Even simple entry and exit rules can generate a profit. There is less trade monitoring required, and the ability to cut your losses quickly while letting your profits run is psychologically appealing. As for me, I trade both styles, with about an 80% bias towards trend following. I'm happy with my profits, and I sleep well at night. Hit the like and subscribe button if you want more content. For a detailed programming guide for the trend following and mean reversion strategies demonstrated previously, check out the videos on the right.